Welcome to the Motley Fool's Crunch Time series, where we scout out a single company from their story to their opportunities and risk. I will start with my prediction. I believe Uber will outperform the market over the next 5 years. First, think of Uber as a four-pillar industry: mobile, delivery, freight, and ads, all run on the same maps, drivers, and payment stack. In Q1 of 2025, the platform handled $38 billion in gross bookings. Uber skims a 27% take rate, then layers on insurance, support, and dynamic pricing algorithms. Now under the hood sits Uber One, a $9.99 subscription that bundles free deliveries and ride discounts. It's a sticky flywheel. 30 million members subscribe. Now, if we look at opportunities, there are a few. The first one is the autonomous, and it leverages without the capital expenditure. Rather than building its own robotaxi fleet, Uber plugs partners like Waymo directly into the apps. Waymo cars are already live in Austin and are heading to Atlanta this summer. Uber provides the riders, Waymo supplies the autonomous vehicles, and both split the fare. That's incremental, high margin gross bookings. Then we have the ads. This is the silent margin engine. Sponsored restaurant tiles, in-ride video spots, and checkout promos now run a 1.5 billion annualized pace, up 60% year over year, all with virtually zero driver costs. Management thinks that ads can reach 5% of gross bookings over time. And finally, in growth opportunity, we have the Latin America super app play. Uber recently announced a partnership in May with iFood, and it folds 55 million Brazilian delivery users into its ride funnel, a wedge back into a market Uber Eats exited in 2022. Now we got to take a closer look at risk. And first, it's just the regulatory smackdowns it gets. On April 21st, the FTC sued Uber over alleged dark pattern enrollment tactics for Uber One. If regulators force driver reclassifications or curb subscription opt-outs, margins can take a hit. We also see that autonomy cuts both ways. A faster than expected Tesla or Waymo rollout could compress Uber's take rate if partners demand a bigger slice or bypass the platform entirely. Next, we also have the overall macroeconomics and competitive heat. Pretty much rides are discretionary. If consumers tighten belts, mobility trips slide. Meanwhile, Lyft, DoorDash, Grab, and emerging Latin America players keep pricing competitive. So these are the main risk. Now, my predictions. Call me bullish. I'm penciling in a 15% annualized total return through 2030. That assumes high single-digit gross bookings, compounded annual growth rate, take rate expansion to 28% at scale. Overall, there is opportunity for this company. To recap, Uber's moat is a multi-purpose logistics stack and sticky 30 million member subscription base. Its growth runway spans autonomous partnerships, a 1.5 billion and growing ad flywheels. Its biggest risks are regulatory wrath and consumer slowdown. I'm still expecting, though, roughly 15% a year from here to 2030. At the Motley Fool, your comments make us all smarter. Please comment with your own research and insight about Uber and tell us what stock you want to see Crunch Time tackle next. Go to fool.com/invest to receive the top 10 best stocks to buy now.